Hey everybody, it's David. It's January and time to look back and talk about those financial results. How did I do as far as my early retirement finances in 2025 and what changes am I planning for 2026? That is what we're going to talk about in this video. Over this past year, I've been doing updates quarterly. Well, this is the big review. How I did over the last 12 months. We're going to dig deep. I'm going to tell you about the funds I'm invested in, how they performed in 2025, and then also some big changes that I have coming up for 2026. So are you ready? Hey, let's talk about it. First of all, the disclaimer. I am not here to give financial advice. I'm not saying that what I am doing is what you should be doing. I simply want to share what I am invested in, how we are financing this early retirement so that you can see. I do something very different in that I share actual screenshots of the funds that I am in, which is quite easy because I'm only in 6 funds for our early retirement. So don't take anything that I say as financial advice. And if you're new to this channel, we talk about 3 things. We talk about achieving financial independence, retiring early, and doing your best to live your best life now. I was laid off in December of 2023, which started our early retirement journey. I have a bunch of videos chronicling that, and I thank you so much for coming by. I especially thank you for the thumbs up. If you get any value from this video at all, please leave me a thumbs up. And hey, down in the comments, I'd love to hear how you did in 2025. What were your results? How did you do? All right, well, let's cut to the chase. How did I do in 2025? My end result for the year was 12.66%. I'm pretty happy with that. It was less than 2025, but still it was enough to cover all of our expenses for 2025 so that we ended with even a larger balance than we started with ultimately is the goal that we want to achieve. First, let's look into my retirement strategy, which I have 5 key philosophies that I'm trying really hard to stick to. The first one is that I am no longer chasing returns. Prior to our early retirement, I had a very aggressive portfolio with no bonds, really no diversity. I was just going for the highest possible return, so I was invested into index funds that had the highest possible returns. When we moved into early retirement, I have done things to make it more conservative. The next thing is I have no individual stocks. I have nothing but 6 simple index funds that I'm using. Those funds I'll be showing you in a little bit. Next is all low-cost index funds. Something I learned from J.O. Collins in his book, The Simple Path to Wealth, is that you didn't need to be fancy in order to get the returns that you needed to retire early. And really, even before reading that book, that is what I have been doing. I've always kept things simple, with just very few funds. Next is no changes based on emotion. You know, back in April of 2025, there was a big stock market crash. Well, I think it was like 3 or 4%, but still at the time it felt big. And I saw a lot of videos and heard people talk about how they were selling things and moving around. Well, I did nothing. And why was that? Although I felt the emotion of the moment, I didn't want to make a quick, sudden change in the short term based on something that may not be a long-term problem. And basically, I was correct. So not doing emotional changes based on short-term situations is something really important in my investment philosophies. Next, and probably most important, is to have a simple, easy to manage portfolio. There's a concept called simplicity bias, and I really think that a lot of people get so caught up in this. And what that means is that our minds think that things that have to be complicated, you think it's complicated in order to save up and be able to retire early, as we did at 56. It's really not that hard. If you are someone who wants things to be simple, which is me, then it's easy to do it. So that is why I keep things so very simple. And speaking of simple, even though I will talk about these funds in percentages, I am doing a 3-bucket strategy. Our 3-bucket strategy consists of cash, where we have 1 to 2 years of expenses parked away in cash, where we have bonds, and by bonds I just have 2 simple bond funds, and in those bond funds I have 2 to 3 years of expenses there. I'm going to be changing that. We'll talk about it later. And then everything else, equities, is in 4 equity funds. Another thing that people like to hear about is our withdrawal and our rebalance strategy. Well, first of all, as far as rebalancing and the changes that we make, I do that twice a year. I only make changes in January and in July. It's a commitment to myself to avoid that emotional changes that I mentioned earlier in the year. So here in January, we have sold enough to pay for that first 6 months of the year. When we get to July, We'll do another withdrawal in order to pay for the second half of the year, leaving a little wiggle room in case something comes up in November and December where we need some extra cash. Yes, I understand that that may impact dollar cost averaging and those kinds of things, but remember my philosophy on keeping things simple. It just feels better to have that money set aside and already in the bank, so to speak, for that 6-month period, and just knowing that it is there. It also keeps it simple when it comes to paperwork. Filling out those tax forms, all those kinds of things with just 2 transactions sure makes it easy. I am also on an ACA plan with a subsidy, so it's really important to track closely my modified adjusted gross income, and keeping those transactions down to as few as possible really helps with that tracking. Okay, now the fun part. I'm going to go through every one of the funds. There's only 6, so it's not going to take very long. And I like to do this for a couple of reasons. I like to do it for transparency. You see the actual percentages up on the screen, but also for a teaching moment somewhat. I love these mutual funds in that it's so easy to read the data and the content and understand. And again, going back to that simplicity. So I'm hoping that by doing this, you can also look up these funds, do your own research, and make your own decisions. So this first fund is the Fidelity 500 Index Fund. I consider it to be my core account. And you can see for 2025, the return was 17.86. Now, it's real important when you're looking at these funds that you look and see how they have done over their lifetime and over the years. This fund, like the S&P 500, which is exactly what it mirrors, has done great at that 17.86. You can see the 3-year at 22.99%, the 5-year at 14.41%, and then the 10-year. What's also really important, and the reason that I love these funds, is that they're very low cost. You can see the expense ratio of this fund is 0.015%, really small in expenses. And then the key thing that's actually pretty cool for you if you're starting out is that the minimum to invest is 0. Yeah, you could stick $10 in this if you wanted to start your investment journey into a fund like this one. And this fund represents 55.5% of our portfolio. It is our core equity fund. Next, we have the Fidelity Blue Chip Growth Fund, which is one that I always go back and forth whether or not I'm going to keep it. You'll see down there it has a little bit higher expense ratio compared to all my other funds at 0.61%. But the historical return on this fund has been great, and it only represents 3.7% of our total savings. You can see the 1-year return on this one was 19.91%, the 3-year at 37.62%, and 10-year at 19.53%. Those high returns have made this one worth keeping. Unfortunately, it is also very volatile. It has big swings up and big swings down. That is one reason that I keep such a small percentage of our savings in this fund. This is the Fidelity Zero Extended Market Index Fund, which is a small cap fund, which I added in 2025 to help add to our overall diversity. And you can see the year-to-date return on this one was pretty good at 12.53%. We'll go across and look at the average annual returns. The 1 year, I mentioned that already, at 12.53. 3 years at 14.32, and the lifetime at 8.32. You'll notice in the title of this fund, it's Fidelity Zero Extended Market. That's because there are no expenses associated with this fund. If you look down, the expense ratio is 0%. And like all of these Fidelity funds, the minimum to invest is also $0. This represents 3.5% of our total portfolio. And speaking of diversity, this is also a fund that we added in 2025, which I was very pleased that I did so. Added this mid-year of 2025. It's an international fund. International is something that I'd stayed away from for many years. But in 2025, I changed my philosophy, and man, am I glad that I did. Look at the returns for this fund in 2025. The 1-year return was 33.54%. You can see the 3-year, the 5-year, and the life. This represents 5.4% of our total portfolio, and it's something that I am adding more funds into for 2026. All right, that's it. That's all the equity funds I mentioned. I only have 4 funds, 4 simple funds, and they're working great for us so far. Now let's talk bond funds. I don't buy individual bonds. I just stick with the index funds that I'll be showing you here. I don't have CDs. I don't have anything like that. So bond funds are the closest thing to fixed income that I have. And bond funds were terrible the last several years. Why is that? It's because of the way that bonds work. When interest rates rise, bond funds tend to drop in value. And over the last couple of years, there were some double whammies. There were times when interest rates were going up, which was causing the bond rates to go down. It also caused things like CDs and high yield savings accounts to go up. So a lot of people didn't want to invest in bonds. But as you can see, things turned around in 2025 where bond funds became a good value. And you can see the 1-year return was 7.13%. 3 years at 4.64. 5 years, that's where that rising interest rate time really impacted it. And then the 10-year at 1.96. Bond funds are not about growth, although that 7%, I'll take that anytime. They're about stability. Bonds can crash as well, as we saw the last couple of years, but they don't crash as much. And that brings balance to your portfolio to help you from those big super swings. This screenshot here is from the actual fund where you go in and read the risk portion of the portfolio. And you can see here it says, as interest rates rise, bond prices usually fall, and vice versa. The effect is usually more pronounced for longer term securities. So in this particular fund, as interest rates fall, something that has happened at the second half of 2025 and is continued to be predicted for 2026, these bonds should go up in value. This next bond fund, FNSOX, is a short-term bond, a little more stable, is not as much impacted by the interest rates going up and down. It's a reason why I have it. I don't have a lot in it at 3.1%. The last bond fund that we have is the Vanguard Institutional Bond Index Market Trust Fund. That fund is within the 401k. It basically is one of those proprietary 401k funds, and I use it to park the money that we take our Rule of 55 withdrawals from. This fund represents 2.8% of our total portfolio. And lastly is the Fidelity Money Market Account, basically where we park our cash. You know, back when interest rates were high, the returns on this cash fund were also high. Well, now in the last 6 months or so, as interest rates are dropping, so are the returns on this cash fund. But we still keep some money there. This is where I take those withdrawals monthly to pay our bills. That's it. That's all the funds. I'm glad to have our investments down to 6 simple funds. So what are we going to be doing differently in 2026? Well, the big thing is that this year I turned 59 and a half, which is pretty exciting because it means I no longer will be needing to do the Rule of 55 withdrawals. About halfway through the year, I plan on doing a rollover of our 401k, and the exciting part is that within our 401k, I have tax deferred money and I have Roth money, and by doing this rollover, I'll finally be able to split them out and take all the Roth money and put it into a Roth IRA and keep all that other money into a rollover IRA that's fully tax deferred. Why this is important is it will finally give me complete control over that Roth money to be able to control what it's invested in and how I'm handling those buckets, something that I'm unable to do right now. As part of our rebalance in the equity account, I'm taking some money out of the S&P 500 index fund and moving more into international. And then I'm also taking money out of that and putting more into our bond funds, taking it up to a 4-year balance to help cover expenses if needed. And then we're also adding more into our cash account, hopefully taking it up to as high as 10% of our total portfolio. Another thing new for 2026 is that our ACA, our medical plan, is HSA eligible, meaning that we're able to contribute into that fund, something we were unable to do last year, which is quite exciting because not only will it help cover some of our medical expenses, it also will help reduce our modified adjusted income by that. I have a couple videos that I think are great about HSA explaining why we did this. Check it out in the description and give them a watch. Well, that was it. This video is a little bit longer than my normal portfolio reviews, but I'm setting up that 2026 while I'm also talking about that 2025. How did you do? Did you have a great 2025? What are you looking forward to in 2026? Are you making any changes? Leave a comment, let me know. I would love to hear from you. I also appreciate any feedback that you want to give me as far as this portfolio design. Even if you disagree with me, I still love hearing from you. Thank you so much for your comments. Thank you for the thumbs up. And hey, thank you so much for being part of the channel. It is going to be a great 2026.